All right, let's go from Suffolk, England, all the way down to Miami. Bring in Kathryn Rooney Vera, head of global macro and chief investment strategist at Bloomberg Capital Markets. Kathryn, I'm sure you had a great time at Bitcoin 2021 or whatever else is going down. It's all one big party down there in Miami. But let's talk.
One big party.
But let's talk about what's going on in the markets here. A lot of expectations right now about what the Fed may or may not do here. When you look ahead at some of the economic data and the Fed meetings coming up here, are you expecting any real change in, I guess, expectations?
Likely not. The Fed views all of the, I would dare say, all of the inflationary pressures as transitory in nature. And I agree, of course, a lot of them are, but not all. We have transitory pressures coming off by the month of July of this year from base effects. Of course, last year was so devastatingly poor in terms of economic growth that we had negative inflation prints for April, May, June, and July. So base effects are going to roll off, remain starting in July and through year end. So my expectation is that tomorrow headline inflation is certainly going to top 4.5%. And we're going to see ugly numbers from now through the end of the summer. But then through year end, you're going to see a deceleration of that pace of price increases because, as I mentioned, base effects roll off and you do have an improvement on the shortage front. But then we roll into the structural nature of inflation, which I think is exacerbated by fiscal and monetary emergency measures that continue at full throttle, despite really effectively the U.S. being leading the pack in terms of normalization and a return to habits of consumption pre-pandemic.
So, Kathryn, if you are anticipating that it is, to a certain extent in the shorter term, transitory, the ugly numbers come, they pass, but then we get back into the longer term view on inflation, what do you do in terms of positioning? What do you do in terms of counteracting that, what you think will be short-term pain that could see significant market moves?
Yeah, that's a great question. And look, I think that people should be positioning their portfolios for that structural outlook. So if we get transitory pressures, which are going to spook the market, I think a lot of it is already priced in. But of course, tech's going to fall, consumer discretionary going to fall. And those are probably the sectors that, according to our quantitative analysis, that least benefit from inflationary scenarios. So I think what we're advising clients is to protect and accumulate positions in sectors in the U.S. that have proven to outperform in structural inflationary scenarios, which my forecast, Caroline, is 12 to 18 months. We're going to see the full effect of fiscal and monetary stimuli combined with an eruption of the U.S. economy. So unless we retreat some of those emergency measures, we're going to get a nice bout of structural inflation over the medium-term horizon. So you want to be positioned in materials, real estate, staples, energy. Those are the sectors that generally do very well. Tips, mining companies, commodities, dare I say even cryptos. There are alternatives in the alternatives world that have low correlation to traditional stock and bond markets, in which I think investors are going to be rightly positioned to outperform over the course of the medium term.
And I want to pick up on something you said at the end there. And you said, dare I say it, crypto as a decorrelation, low correlation, negative correlation to some of the stocks and bonds. Where does crypto fit in the portfolio?
Yeah, look, crypto, I think you should have a small allocation within the alternatives portion of your portfolio, which I think a generalized, diversified, and strong portfolio should have some allocation to alternatives. Alternatives, of course, Taylor, as you know, is a world of its own. We're just not talking about venture capital and private equity, but we're also talking about commodities, gold, we're talking about mining, we're talking about copper, we're talking about cryptos. So if you look at cryptos, specifically Bitcoin, it is kind of a hedge against a weakening dollar. And if you are of the camp that sees some crisis of confidence with regard to fiat money or a devaluation of the U.S. dollar over the long-term horizon, then you do stand to benefit from having a portion. I'm not saying go 20% of your portfolio into cryptos, but I wouldn't advise against taking advantage of this slide in Bitcoin to accumulate a small portion as a uncorrelated or low correlated asset that benefits both from a weakening of the U.S. dollar and acceleration in structural inflation.
We want to thank you, Kathryn Rooney Vera, head of global macro and chief investment strategist over at Bloomberg Capital Markets down there in Miami.